Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities, sharing those opportunities with everyone in the community. I look for large asymmetric opportunities across the commodity space where I cover precious metals. I cover basically base metals, precious metals, base metals, energy, which is uranium, oil, nat gas, energy services. I look into steel, iron ore, coal, met coal, tankers, dry bulk shipping. I look at all that stuff. There are a heap of opportunities out there right now that are bottoming. I look at lithium too and other tertiary markets. I can pretty much look at any market and determine if something looks pretty good or bad for a longer term picture. If that sounds interesting to you and you want to get a little bit more of a different opinion on the commodity bull market that we are in, you can sign up. Special is the coupon code. It is 50% off the first month only on a monthly membership and a $100 discount on the yearly membership. And you can always swap from a monthly to a yearly if you'd like to stay on for a year. So Dow equals 1. There are a lot of silver charts out there, but have you seen this one? The depth of the cup is equal to the vertical height of the 30-year ascending channel. Elegant TA would give us a measured move right at the top rail at around $666 an ounce in April of 2029. Is that possible? It is. It's possible, yes. Now, does that mean that we should go pile all in on silver? No. I think you should have enough exposure in silver for it to matter. That's the big question isn't guessing the right sector, putting all your money in one sector. The best question I think people can ask is, okay, we've got these 6 or 7 different opportunities or more. How much should I put into it where it will make a difference in my life? And you don't want to go way overboard. You don't want to gamble on one sector necessarily. And then you have to figure out, okay, should I allocate to the physical metal, to an ETF, to mining companies, junior mining companies? And what are the risk profiles for each of those different investment vehicles, all against silver? And that's really how you develop a portfolio. You have to ask all of those questions. But yes, that is very possible. And you know what's even more crazy? I don't know if you guys have looked at a platinum to silver ratio. If, and I don't know this is going to happen for sure, but if silver does get up here and platinum outperforms silver on like a 3 or 4 to 1 basis, can you imagine what that would do to the price of platinum? I mean, we are so cheap right now in that metal. It is ridiculous. Now, I don't know if it'll do that. It could. And that's where you have to go back and say, well, how much exposure do I want to each of these potential investment opportunities? And how big could those opportunities be? And this is kind of measuring up what could happen. Now, a lot of people, retail investors, seem to fall in love with what could be. You have to make sure that you have a reasonable expectation and a reasonable outcome. So just because someone said it could potentially go to $666 an ounce and that this chart could suggest something like that, the question then becomes, well, how long will it potentially take? We don't know. We don't know. That could be 20 or 30 years out. Maybe it doesn't happen by 2029. Maybe it does. We don't know that for sure. Coming down, Peter Schiff says lower interest rates won't help the economy this time. The markets will see through the political nature of inappropriate rate cuts despite rising inflation and soaring budget deficits. the dollar will sell off and bond yields will rise, pushing up inflation and unemployment. Well, I think he's right, and this is what I'll say. If they lower rates and rates actually go down, I do think it would help the economy. So if we get lower rates, so that's a big if we actually get lower rates on the 10-year and 30-year and stuff like that on the long end, I do think the housing market would go up. And I do think that employment related to residential real estate would go up, not down. But he could be right where they go to lower interest rates. The market says, I don't want your crappy bonds because we know what you're doing. Then the long end of the curve would go up because they would say, you know what, the Federal Reserve is not serious about fighting inflation. So then interest rates go up, not down, which everyone thinks is going to occur. And then you'll get money rotation out of some of these sectors that are sensitive to interest rates. And that will include the NASDAQ. It will include financial assets like stock equities if rates get to certain levels. So at this juncture, I am not exactly sure what will happen if they lower the short end of the curve. I'm not sure what the long end will do. We have to watch that and see what kind of reaction the market has to government and the Federal Reserve trying to get rates down. Peter Schiff again says 4 months, Powell claimed the U.S. labor market was strong. We now have official confirmation that it's only been weaker during major recessions. His forecast on inflation coming down will prove just as inaccurate. We are on the cusp of the greatest stagflation in U.S. history. Now, this is what I'll interject. How do we know these numbers are correct? Perhaps we have a strong labor market. Perhaps the numbers are being fudged, and they're fudging them into thinking, getting the market into thinking that we have a slowdown so that rates will drop. Maybe they're trying to funnel money into the bond market, and they're going to do everything that they possibly can to get money to run towards bonds. The only way they can get money to run towards bonds is to manufacture a slowdown. When they raise interest rates, people say, well, they're trying to slow inflation, so they raise interest rates. Well, no, inflation comes into the system and people don't want bonds. So when they don't want bonds, interest rates go up because they sell bonds and rates have to go up to entice new buyers at higher interest rates. What if that doesn't work? What if rates go up and buyers don't show up? What if they lower rates on the short end and the long end goes way up and buyers do not show up? If they step in there and they go and they buy a bunch of bonds, they're going to tank the dollar. I mean, that dollar is going to tank. Now, there's a couple of asset classes like commodities and precious metals that could benefit under both scenarios if rates go up or if rates go down, because now bonds are not a viable alternative for an investment for some people. And as more jump on that bandwagon, more money is going to get diverted into precious metals, which is a much smaller market than the bond market. So it doesn't take much money to move gold or silver or any of these way higher. So keep that in mind. Here's Anas. He says, daily energy report, U.S. gasoline inventories, they're still going down. I thought, with oil at the price where it's at, you would think that gasoline inventories would be building, but that's not the case. And we're at the lower end. That's not at the upper end. That's at the lower end. So demand looks strong to me. I don't think it looks that weak at this moment. Once again, Kramer worked his magic. It says, wow, thank you, Jimbo. He says, I like gold, but that's a bad reversal. And then it says, please just say you hate gold so it keeps going higher. I love that. I love that. So investment wisdom, he says, we really like the decision to be obvious enough to us that it doesn't require making a detailed calculation. If you cannot decide, the answer is no for Naval. And let's just read this real quick. So what's highlighted is if you find yourself creating a spreadsheet for a decision with a list of yes and no's, pros and cons, checks and balances, why this is good or bad, forget it. If you cannot decide, the answer is no. So by definition, if the two are even and one has short-term pain, that path has long-term gain associated. With the law of compound interest, long-term gain is what you want to go towards. Long-term gain, not short-term. Everyone and their frickin' mom is all about short-term price movements. They get afraid because the stock went down. You guys realize that the stock and the business are two separate entities that can perhaps trade differently. And the very thing that we are taking advantage of is that disconnect between the stock and the business. Now, some of these are just out of cycle. Commodities, when they go out of cycle, that's when they get incredibly cheap. And that's when you want to invest in them. But in the short term, it's just a bunch of emotional investors going in and out of stocks, and then that impacting emotional investors. And the very thing that we are taking advantage of are those emotional investors. We are buying from emotionally weak and scared, fearful investors, buying their shares and then just sitting in it and waiting for the fundamentals to catch up to the business, the stock price to catch up to the business, I should say. Martin at B of A says falling construction spend leads into a recession signal. So this is falling construction spend leads into a recession signal, which is below kind of this 0%. And that very well could result, or we could be in a slowdown. And this is U.S. construction spending year over year change in the U.S. recessions. And this is completely true. This chart is legit. Now, somebody said, oh, we're in a big expansion phase and we're in um, the winner's curse phase. No, we're not. We can't be with this. If we're in a winner's curse phase, how the heck are we going down in falling construction spend? I said since about 2022, this decline is a mid-cycle wobble. Now that mid-cycle wobble is very similar to 2000. We came back down here, very similar to this, and then we had a big boom. You know what created that boom? Declining interest rates and a weakening dollar. And what are we going to do right now? Declining interest rates and a weakening dollar. That, in my opinion, is more impactful to the cycle than anything else, my opinion. This is absolutely insane. The U.S. just revised the June jobs report lower for a second time for a total of minus 160,000 jobs. Now the U.S. has officially lost 13,000 jobs in June, the first negative month since July of 2021. What just happened? Let us explain. Well, we can dive into it real quick, but there's the jobs loss in June that was revised lower right there, that little red one. You can see that we've been trending lower here. So if we go in and just touch on this real quick, the June jobs report has now been revised lower by about a total of minus 160,000 jobs. This is more than the initially reported gain of 147,000 jobs, a seriously concerning trend in our data. If this is not a broken system, it's hard to say what is. The fact that May and June jobs reports were just revised lower by a combined minus 280,000 jobs, and every single job report in 2025 has been revised lower aside from July. Not only is something wrong with our data, but the labor market is entering a recession territory. Meanwhile, today's data showed the U.S. added just 22,000 jobs in July. This was below 79 of 80 forecasts, according to Zero Hedge. And the unemployment rate in the U.S. rose to 4.3%, marking the highest reading since October of 2021. Things are getting very ugly for U.S. consumers. I'm not gonna go through all this. Um, I can see it in all the charts. I don't need someone to tell me. So, are things slowing down? I would say that we are bottoming. Even though this jobs report and people think that this is important, it could be, um, but we're bottoming in all the chart patterns. So I would say that we're probably bottoming if you look at the positioning in the markets, and probably the worst is behind us. That would be my guess. Now, I could be wrong. Maybe something is out in front of us, and if they continue to lower numbers, who knows? Maybe, just maybe, they are lowering numbers to try to get interest rates down, and I'm not exactly sure it will work. Not exactly sure. So I don't know if these numbers and how legit these numbers really are because they've been revising them all over the place. This is XPT, which is platinum. On it says one of the most bullish commodities metals at this moment, and this is a Renko chart. Renko chart kind of takes out all the fluff, right? This is a Renko chart coming down, and we've broken out of everything. This is in a bull market, and that's all that matters, guys. Like you got to just take the big picture view like this and say, hey, look, we've broken out of everything. This is a bull market, and that's all you need to know. When you're an investor, you know what I did? Bought down here, or sorry, I bought down here in 2020. I bought the whole bottom of this. Then I'm going to sit and wait, have this go all the way up, wherever it ends up going. And because it's a bull market, I'm just riding the bull market. It's that easy. That's how you make money. You ride it from down here, and then you ride it all the way up this bull market, and then you try to sell out when it turns. That's it. Simple as that. Time's up. So civilian unemployment rate. And it looks like we're doing a little bit of a breakout there to the upside. Now, does this mean that this is the beginning of a slowdown? It could be. It could be. Now, here's the thing. Is this stagflation? It's an inflationary recession. That could be the case. That's why gold is ripping. Gold does incredibly well under a slowdown and inflation. That's when it rips. Same with silver. Silver will do the same thing. And platinum could go too. And then oil will come lagged a little bit behind it. It'll be ripping higher too. And it's when the market starts to firm up, that's when oil will start to go. But in the short term, if this goes up, gold's gonna fly. Gold, silver, the mining companies, they're all going to do incredibly well in the short term if that continues higher, which it looks like it could. This is DXY in the Renko. Are we seeing the third major technical Renko breakdown, the dollar index unfolding now? We could be. We could be. We could still have one surge higher too. We don't know yet. We have to see what occurs. Generally, what occurs on a weaker dollar is when they lower interest rates. That's when the dollar falls, generally. Now, this time around, I don't know. Wait and see. They may have to force it out of that and force it lower. Why do I say force it? Because I think the long end of the curve is going to go up. I don't know if they're going to be able to lower rates across the board. And that's where my hesitancy is. Like, do they really have this, under control, or I don't know. We'll have to wait and see. The always dedicated and knowledgeable Mike Maloney made a good video about one of my charts once again in the link below. So what is this? This is back in July 16th. There will be no bubble phase in this gold bull market because this time around, after the present final third bull move, the world will have a new monetary system backed by gold. This will pin gold at the highs value-wise, meaning there is no bubble. And that means this is not only a normal bull market, it is also a global monetary system reset. It is vital to grasp that this is not gold going up. It is mostly currencies depreciating. So for heaven's sake, do not miss it. The third bull move, which will kill the present global monetary system. The largest 3 drives up move I've ever seen. 3 drive up move ever seen here. And first bull move was after Nixon ended the gold standard in 1971, done by the people behind Nixon, to be more correct. We had the second bull move, and we're in third. That's going to kill current global monetary. This is uranium. So we've got uranium spot price still long-term bull, an inverted shoulder head and a shoulder on the Ranko, a broken neckline. Then we have a big bull flag in a retest back to this line here, and then we've broken the bull flag to the upside. We're in a big long-term bull market, guys. We are in a bull market for uranium. Uranium, gold, silver, oil is going to come to. They're all going to go up, guys. Steel, copper, it's all going to go. We're in the commodity bull market. Now, is the dollar going to drop immediately? I don't know. That's usually what kicks this whole thing off. It's when the dollar gets weak. Another one for Peter Schiff. He says Trump is renaming the Department of Defense the Department of War, with Pete Hegseth becoming Secretary of War. While he's at it, Trump should also rename the Department of Treasury the Department of Debt, with Scott Bessent becoming Secretary of the Debt. Both names seem more appropriate. There we go. Secretary of the Debt. Breaking, the U.S. economy adds 22,000 jobs in August, below expectations of 75,000. The unemployment rate rises to 4.3%, in line with expectations of 4.3%. This marks the second lowest jobs report number since July of 2021. The labor market is rapidly deteriorating. Are we going to get a recession? So a lot of people are going to read this and you say, oh gosh, we're going to get a recession. I better change my stocks. No, 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 no. What is the positioning occurring in the markets? How is it being positioned? What do the charts tell you? How is this data being interpreted by those that are deploying large amounts of capital? So just because you think a recession is coming doesn't mean that you should change your positioning in the market. Because what matters is what big money is doing with their money. Remember, a lot of those guys have insider information. So they may be releasing this information to get you to behave a certain way. Guys, you got to see how the big boys are positioned, and that's where the value is with technical analysis. Breakaway, freight futures AM update. Dry bulk, Capesize, and Panamax are flat. VLCC of tankers is up 3%. Suezmax is flat. JC says, I keep being told about all these tops people are seeing all over the market. I just see a lot of bottoms. Here are a few. IWM saying it's a bottom. DJ Transportation, DJT, then the All World Index. Now I'm all about the All World, All Country World Index here. That's where I would be. I like it because I think the dollar is going to go down. So those other currencies are more than likely going to go up against the dollar, and that's generally been the fuel for money rotation into emerging markets and international equities. This is from Jordan. He says, pros and retail are underexposed to gold and gold stocks. It's slowly changing. It will accelerate when gold versus the S&P 500 breaks out from this 11-year base. Ratio just bounced at major support and upward sloping 200-day moving average. Breaking out of this base gives gold the fuel to double to $7,000 an ounce. This is the gold to SPX ratio, and we're looking for a breakout here of this horizontal resistance line, which is a gigantic base. We're going to get more momentum as this base, you can see the lows here. The low is 2022. That was the bottom. This is going to start to build higher lows into that resistance and break through that resistance. That's when the big moves and momentum occur. What we're doing, we're going around and buying the bottoms in a bunch of junior companies and small mid-cap producers already to play this big move. But that's what we're doing on the website. We're going around buying all the bottoms. Now, this takes time. It doesn't happen fast. It's not immediate. It takes time, and we're gonna play this with. Hopefully, we have a couple 1,000% gains plus. That's a 10-bagger. hopefully have a bunch of 10 baggers sitting in the portfolio here, which I think we do. I think we have, I think there could be some like 40 or 50 baggers in there. There could be more than one too. We could be sitting on a handful in the gold and silver junior space if you properly allocated across some of those small juniors. Tavi says the 2-year yields approach multi-year lows as commodities approach all-time highs. This is the environment we are in. Cut rates to service debt, let inflation run hotter. Higher commodity prices are the release valve in his view, which I agree. This is cut rates. This is commodity prices going up. It's that let inflation run hotter. Well, it's coming. I'm positioned for this. I am positioned exactly for what he's describing. Yikes, look at the M2 money supplies around the world. Vertical, 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 and vertical. You know what M2 money supply creates? Inflation. You know what happens if oil can't keep up with this? Which it can't. Oil prices go up. You know what they're going to be trying to do? They're going to try to hold oil prices down because that is the conduit into the consumer price index going up. It's print money, it flows through the system, then it'll end up going into oil prices because oil's in everything. That's all I've got for today, guys. So that's where we're going to end it. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you like, special with the coupon code. We've got a Sunday question and answer session at 5 p.m. Mountain Time. You can ask me whatever you want, and I can answer whatever you guys have questions about. In the beginning of that, we'll probably go over some things, probably talking a little bit about my approach, strategy, some technical analysis, and what I'm seeing in the market. All right, guys, that's all I've got. We'll catch you next time.